$24 billion. That is how much money has quietly poured into dividend ETFs in the first 3 months of 2026, the strongest start in 4 years. And while most investors are still chasing AI stocks and meme tickers, a small group is doing something boring on purpose. They are buying 18 specific dividend ETFs and just sitting on them. Number 4 owns only companies that have raised their dividend for at least 25 straight years. Number 11 is basically your dad's retirement account in one ticker. And number 18, the one I would actually own if I could only pick one of all 18, has historically beaten SCHD by more than 1 full percentage point per year for a decade. I have spent the last 8 years tracking every dividend ETF that matters in the US market, and today I am breaking down all 18 of them in order from the obvious foundations to the climactic pick that almost nobody talks about. Boring is the strategy. Stay with me. Here is how this video works. I split the 18 into 3 chapters. The first 6 are what I call the foundational picks, the obvious ones every dividend investor needs to at least know exist. The middle 6 are hidden, in the sense that they get a fraction of the YouTube attention SCHD and VYM do, but they have been compounding for years inside portfolios you never hear about. And the last 6 are the specialty toolbox, the income machines, and the climactic answer to the question I get asked more than any other on this channel. If you could only own one dividend ETF for the rest of your life, what would it be? We will get to that answer at item 18. Quick disclaimer before we start. I am not a financial advisor, and this is not financial advice. Everything I am about to share is for educational purposes only. Always do your own research before making any investment decisions, and remember that past performance does not guarantee future results. With that out of the way, let us begin. The reason I am doing this video right now in 2026 is because of one number. Reuters reported in late March that US dividend funds pulled in around $24 billion in the first quarter alone, the strongest first quarter inflow in 4 years. SCHD by itself attracted roughly $4 billion of that. Investors are tired of guessing which AI chip company will lead the next leg up. They want something that pays them while they wait. That is exactly what these 18 ETFs do. So, if you have been searching for the best dividend ETFs for 2026, and you are not sure which ones actually deserve a spot in a long-term portfolio, this is the video for you. One quick note on how I picked these 18. I did not just sort by yield or by assets under management. I looked at the funds that have a real, transparent rule for picking dividend stocks, that have been around long enough to have a track record across at least one full market cycle, and that charge fees low enough that you actually get to keep the dividends. I excluded a few popular funds that I think have proven yield ceilings or methodology problems, and I left out the brand new high-yield products that look attractive on a 1-year chart but have not been tested by an actual drawdown. So this is not a top 18 in the algorithm sense. It is the 18 I would walk a relative through if they asked me how to actually build a dividend portfolio in 2026. Chapter 1. The Foundational 6. These are the obvious picks, the ones that any serious dividend investor should at least understand. They are cheap, diversified, long-tenured, and together they could reasonably make up 60 to 80% of a sensible retirement portfolio. If you only learned 6 tickers from this entire video, learn these 6. Item number 1. SCHD, the Schwab U.S. Dividend Equity ETF. Yield around 3.3%. Expense ratio of just 6 basis points, which means $6 per year on every $10,000 invested. Assets under management have climbed to roughly $86 billion, making it one of the largest dividend ETFs on the planet. SCHD owns about 100 quality dividend payers and has paid a dividend every single quarter since launch in 2011. The latest quarterly payout in March of 2026 was about 25.7 cents per share, which was a 3.3% raise over the same quarter last year. No drama, no surprises, just a slightly bigger check than last year. Top holdings include United Health Group, Texas Instruments, Qualcomm, and Broadcom. The sector mix leans into technology, healthcare, and financials. SCHD is the gravity of this entire universe. Almost every other ETF on this list either complements SCHD or competes with it. Over the last decade, SCHD has historically delivered around 12.3% annualized total return with dividends reinvested, which has built a lot of seven-figure portfolios for people who did nothing other than hold it. If you want a starting point for a dividend portfolio in 2026, SCHD is the default answer. Hold on to that 12.3% number, because we are going to come back to it when we hit item 18. Item number 2. VYM, the Vanguard High Dividend Yield ETF. Vanguard's answer to SCHD, but built on a much wider base. VYM owns over 600 large blue-chip dividend stocks. Same expense ratio as SCHD, 6 basis points. Assets under management north of $90 billion. The current SEC yield is around 2.4%, with a trailing dividend yield closer to 3.5% depending on how you measure it. Top holdings tilt toward Broadcom, JP Chase, and ExxonMobil. The sector mix is heavier in financials and energy than SCHD's, with healthcare and consumer staples filling out the rest. VYM is the broad alternative. If SCHD feels too concentrated for you with only 100 names, VYM gives you 600 large-cap blue chips for the same 6 basis point cost, and no single holding makes up more than about 6% of the fund. The trade-off is a slightly lower dividend growth rate over time, because VYM waits for current yield rather than for the consistency of yearly raises. VYM is what a financial advisor recommends when they want one ticker that covers the entire US high dividend universe. Item number 3. DGRO, the iShares Core Dividend Growth ETF. This is where we shift from current yield to dividend growth. DGRO yields only about 2% today, which sounds underwhelming. But its dividends have grown around 9.5% per year over the last 5 years, which is one of the highest growth rates in this entire video. Expense ratio of 8 basis points. Assets under management around $37 billion. About 400 holdings. Top names include Broadcom, JP Chase, Apple, and Microsoft, with technology making up roughly a quarter of the fund. DGRO has a sibling on this list called DGRW that we will meet at item 18. Both chase dividend growth rather than raw yield. Both own broadly similar quality companies, but the way they screen for those companies, the providers running them, and the total returns they have delivered over the last decade are very different. Hold that thought, because the comparison at item 18 is one of the most important moments of this video. The short version is that two ETFs with almost identical philosophies can produce surprisingly different 10-year outcomes depending on which screening rules they actually apply. Item number 4. VIG, the Vanguard Dividend Appreciation ETF. The largest dividend growth ETF in the world by assets under management, sitting at over $104 billion. Yield is the lowest of the foundational 6, just 1.5%. But the expense ratio is also the lowest, 4 basis points. VIG only includes companies that have raised their dividend for at least 10 years in a row, which automatically filters out most of the hype names that have not survived a recession. Top holdings include Broadcom, Apple, Microsoft, JP and Eli Lilly, 343 names in total. Over the last 12 months, VIG has historically returned about 21.5% on a total return basis, and over the longer haul has delivered around 10% annualized since inception. If you want a fund that buys quality and then sits on it, this is it. Now think about Harry, a 60-year-old who finally gets to retire. He puts $100,000 into SCHD 10 years ago and walks away. Based on historical performance, that account today could be worth around $320,000, with around $10,500 in annual dividend income coming in if he turns reinvestment off. That is a yield on his original money of more than 10% just from sitting on a quiet ETF for a decade. SCHD is the most familiar example of how this works, but the same kind of arithmetic applies to VIG, NOBL, and the rest of this chapter. Item number 5. NOBL, the ProShares S&P 500 Dividend Aristocrats ETF. NOBL takes the Aristocrats methodology and turns it into one ticker. Every single stock in Nobiel has raised its dividend for at least 25 consecutive years. Some of these companies were already raising dividends before you were born. The yield is around 2.1%. Expense ratio is higher than the index funds we have covered, at 0.35%, because aristocrat screening costs more to run. Assets under management sit around $11 billion. NOBL only holds about 70 stocks, equally weighted, with top names like Caterpillar, Franklin Resources, West Pharmaceutical Services, Nucor, and Archer Daniels Midland. The sector mix is heavily weighted toward consumer defensive and industrials, the kind of slow-moving businesses that pay you whether the economy is roaring or shrinking. The reason NOBL is a foundational pick rather than a hidden one is that the Aristocrats label carries genuine information. To get into the index, a company has to survive 25 years of recessions, oil shocks, dot-com busts, financial crises, and pandemics, while raising the dividend every single year. That filter alone removes most of the market. What you are left with is roughly 70 companies that have proven, over a quarter century, that they can keep paying. Since inception, NOBL has historically returned roughly 10% annualized, very close to the broad market, with significantly less drama in any individual year. Predictability that almost no other dividend strategy can match. Item number 6. HDV, the iShares Core High Dividend ETF. HDV is the moat-tilted, defensive, high-yield cousin of the foundational 6. The methodology screens for companies with strong financial health and durable competitive advantages, then weights toward the highest yielders within that filter. The expense ratio is just 8 basis points. Assets under management around $13.5 billion, about 70 to 80 holdings. Top names are heavy in energy, with ExxonMobil at over 8% and Chevron at over 6%, plus Johnson & Johnson at around 5.5%. Sector exposure is concentrated in energy, healthcare, and old-school telecom. HDV has lived in that same defensive corner of the market since launch in 2011. The top holdings barely move year to year, which is exactly what its investors want. If you have a SCHD or VYM core, and you want a defensive sleeve that pays a higher current yield with a tilt toward businesses that throw off cash no matter what the macro picture looks like, HDV is the one to pair with them. Just understand that the energy concentration means HDV moves with the price of oil more than the dividend growth ETFs do. That wraps the foundational 6. If you are still here at item 6, you are already doing something most investors will not do. You are sitting through the slow part on purpose. The next 6 are the ones almost nobody on YouTube talks about. One of them runs a system that has been mailing checks to investors since 2004. One of them is actively managed by a firm older than most of the ETFs we just covered. And one of them deliberately buys the highest yielding stocks in every sector and then refuses to touch them for an entire year. These are not exotic products. They are clear rules, dressed in tickers most people have never heard of. Stay with me. Chapter 2. The Hidden 6. This is the dopamine layer. These are funds that almost no retail investor brings up in a comment section, but they run clear, old-school rules on dividends and value. Each one earns its slot for a different reason. The hook here is simple. You do not need to chase exotic 18% yield products to get something a little spicier than SCHD. These 6 get you there using transparent rules and decades of history. Item number 7. SCHY, the Schwab International Dividend Equity ETF. This is exactly what you think it is. SCHY takes the SCHD algorithm, points it at the rest of the world outside the U.S., and then leaves it alone. Yield is around 3.4%. Expense ratio of 14 basis points, slightly higher than SCHD because international funds always cost a bit more to run. Assets under management around $1.8 billion. About 100 holdings. Top names include large European energy companies like Eni and Total Energies, plus Allianz from Germany, all chosen for high quality and high dividend characteristics. The reason SCHY matters is simple diversification. The US market is around 60 to 70% of global equity market cap, but 100% of most American investor portfolios. Adding SCHY gives you international exposure with the same screening philosophy you already trust from SCHD. And during periods when the dollar weakens, like we have started to see in 2025 and into 2026, international dividend ETFs like SCHY can quietly outperform their US cousins. SCHY is also one of those funds where the small asset base actually matters in a good way. Because it owns roughly 100 names, it can stay closer to the original methodology without getting forced into bloated, market cap-weighted positions over time. Item number 8. PEY. The Invesco High Yield Equity Dividend Achievers ETF. This is one of those funds that fits the pattern of this video in the most literal way. PEY just owns 50 of the highest yielding dividend achievers and has been sending out checks since 2004. That makes it one of the oldest high-yield factor ETFs on this entire list. The expense ratio is on the higher side, 0.53%, because PEY runs an active rotation among dividend achievers, which are companies with at least 10 years of dividend growth. Assets under management are just over $1 billion, so this is genuinely a smaller fund than the foundational picks. Top holdings include Insperity, LyondellBasell, Robert Half, Eastman Chemical, and Target. The sector mix tilts toward industrials, materials, and consumer defensive. The big practical advantage of PEY is that it pays monthly. While SCHD and VYM mail a check 4 times a year, PEY mails one every single month. For a retiree who wants smoother monthly cash flow without giving up the dividend growth screen, PEY is one of the most underrated options on this list. The combination of a long history, a focused 50-stock portfolio, and monthly distributions makes PEY a textbook example of an ETF that does one job extremely well. The other thing I like about PEY is its discipline. Once a year, the index reconstitutes, the lowest yielders fall out, and new dividend achievers take their place. The fund manager does not chase whatever is hot in any given quarter. That kind of mechanical, rules-based rotation is what investors actually want when they are building a long-term income stream that they do not have to think about. Item number 9. CGDV, the Capital Group Dividend Value ETF. This is the only actively managed ETF in this video, and it deserves its slot for a specific reason. Capital Group has been managing money since 1931. They are not a startup ETF shop. They wrapped their dividend value strategy in an ETF wrapper in 2022. And the response has been remarkable. CGDV has grown to roughly $29.5 billion in assets in just over 3 years, which is unusually fast growth for an active strategy in a market that has been moving toward passive for 2 decades. Yield is on the lower side, around 1.3%. Expense ratio of 0.33%, which is high for a passive ETF but extremely low for active management. About 50 holdings. Top names are surprising for an actively managed value fund. They include Broadcom, Nvidia, Microsoft, Philip Morris, and ExxonMobil. CGDV is essentially a concentrated high-conviction dividend portfolio dressed in an ETF wrapper. The active manager picks roughly 50 names with a mandate to beat the market on dividend value rather than trade every macro headline. If you have ever wondered whether active management can still beat passive in the dividend space, CGDV is the cleanest answer to test that question with right now. The track record is short because the fund itself is new, but the firm behind it has been doing this for almost a century, with one of the longest active management track records in the industry. CGDV is what you choose when you want a quietly active manager working on your behalf without paying mutual fund-era fees or sacrificing the tax efficiency of an ETF wrapper. Item number 10. RDIV, the Invesco S&P Ultra Dividend Revenue ETF. RDIV is the contrarian pick of the hidden chapter. The methodology screens for ultra-high-yielding stocks in the S&P 900 and then weights them by company revenue rather than market cap. The point of this revenue weighting is to avoid classic yield traps, where a falling stock price artificially inflates the yield while the underlying business shrinks. Expense ratio is 0.39%. Assets under management are just under $1 billion. About 60 holdings. Top names include Chevron, Prudential Financial, AT&T, Clorox, and Public Storage. Sector exposure is heavy in energy, financials, real estate, and utilities. RDIV is the ETF you choose when you want high current yield, but you want it built from companies that actually generate real revenue rather than companies whose share prices have collapsed for a reason. The contrarian framing makes it a great pairing with a growth-tilted fund like DGRO or DGRW. If you ran a portfolio with 80% in DGRW for total return and 20% in RDIV for current income, you would have a barbell that captures both ends of the dividend universe with very little overlap. Item number 11. DJD, the Invesco Dow Jones Industrial Average Dividend ETF. DJD is the most charmingly simple fund on this entire list. The methodology is almost too straightforward to believe. Take the Dow Jones Industrial Average, the 30 largest blue-chip companies in America, and then just tilt the weighting toward the higher dividend yielders. That is it. Expense ratio of 7 basis points. Assets under management are small, around $450 million. Only 30 holdings, one for each Dow component. Top names include Verizon at almost 10%, United Health at over 7%, Chevron at almost 7%, Merck at just under 5%, and Coca-Cola right behind. The sector mix tilts toward healthcare, consumer staples, and industrials. DJD is what I call Dad's portfolio in one ticker. It is what an old-school investor would have built by hand in 1990, owning a slice of every Dow company and tilting toward the ones paying the most. The fact that this ETF exists today, with 7 basis point fees, lets a 30-year-old build the same kind of portfolio without ever having to think about it. The small asset base actually works in DJD's favor. With only $450 million in assets and just 30 holdings, the fund can stay precisely on its mandate without the bloat that comes with managing $50 or $80 billion across hundreds of names. Now, we hit the part where most investors get into trouble. The next 7 ETFs include some that pay yields above 10% every year. And every one of those yields comes with a price you are not always told about. If you do not understand what that price is, you can quietly lose money for a decade while watching big checks land in your account. Item 12 is the bridge between the high-yield section and the climactic ones at the end. And by item 16, we will have covered every covered call ETF that matters. One of them, the one in the climactic spot, is the only one I would put my own money into without a second thought. Stay with me. Item number 12. SDOG, the ALPS Sector Dividend Dogs. ETF. SDOG codifies the dogs of the Dow idea into an actual rules-based ETF. The methodology picks the 5 highest-yielding stocks in each of the 11 S&P sectors, equally weights them, and rebalances once a year. Then it does nothing for the next 12 months. Expense ratio of 0.4%. Assets under management around $1.33 billion. 50 holdings, 5 per sector. Top names include Microchip Technology, Texas Instruments, Hewlett-Packard Enterprise, Evergy, and Kenvue. The reason SDOG matters is what the equal sector weighting does over time. Most cap-weighted dividend ETFs end up overweight in financials and energy. SDOG forces equal sector exposure, which means when one sector gets crushed, you are not crushed with it. That mechanical rebalance once a year is the entire strategy. Now picture Harry deciding he wants to split his retirement income between 3 styles. He puts a third into SCHD for the foundational core, a third into NOBL for the aristocrat's predictability, and a third into SDOC-REO for the equal sector contrarian tilt. 3 different strategies, 3 different rule sets, 1 portfolio. He could leave it alone for 20 years and still be confident in what he owns, because each ETF runs on a transparent methodology that he could explain to a 15-year-old. That is the kind of simplicity most retirement portfolios never reach. Chapter 3. The Specialty Toolbox. This chapter is where the dividend universe stops being just about long-term total return and starts being about income tuning. The first 4 ETFs in this chapter are the covered call workhorses, the funds designed to convert market exposure into monthly cash flow. The last 2 are the climactic picks. Number 17 is the international ballast that quietly diversifies away U.S. concentration risk. And number 18 is the answer to the "if you only own one" question. We are getting closer. Stay with me. Item number 13, JEPI, the JP Morgan Equity Premium Income ETF. JEPI is the flagship covered call income ETF in the U.S. market. Yield around 8.33% on a trailing basis, with a 30-day SEC yield of about 7.5%. Expense ratio of 0.35%. Assets under management around $45 billion, making it one of the largest income ETFs on the planet. About 120 holdings. The top names tilt toward defensive low-volatility large caps like Alphabet, Amazon, Ross Stores, Texas Instruments, and Merck. The strategy is straightforward. JEPI owns a low-volatility slice of the S&P 500 and then sells call options through equity-linked notes to generate the 8% yield paid monthly. The trade-off is upside. JEPI has historically captured most of the income from a typical bull market while giving up a meaningful chunk of the price appreciation during big rallies. For a retiree who values predictable monthly cash flow over capital appreciation, JEPI is the workhorse choice. If Harry put $25,000 into JEPI for monthly income today, based on the current 8.33% yield, he could potentially collect roughly $2,080 per year, or about $170 per month before taxes. That is real money landing in his account every single month. Item number 14, GPQ, the JP Morgan Nasdaq Equity Premium Income ETF. Same shop as GPI, same idea, but pointed at the Nasdaq 100 instead of the S&P 500. Yield around 10.5% on a trailing basis, with a 30-day yield closer to 12%. Same 0.35% expense ratio. Assets under management around $37 billion. About 109 holdings. Top names are the Nasdaq megacaps: NVIDIA, Apple, Alphabet, Microsoft, and Amazon, with information technology making up the dominant sector exposure. The trade-off compared to JEPI is volatility. JEPIQ pays you more, but you ride the Nasdaq's bigger swings on the way. Over the last 12 months, JEPIQ has historically delivered a roughly 28% total return, but most of that comes in choppy bursts that test the patience of investors who only look at the monthly distribution number. JEPI is the calmer S&P 500 paycheck. JEPIQ is the spicier Nasdaq paycheck. Same shop, same playbook, very different risk and reward profile. The simplest way I can explain the choice is this. If you would rather sleep well most nights, choose JEPI. If you can tolerate more drawdown in exchange for a bigger check, choose JEPQ. There is no wrong answer. There is just a wrong answer for you, depending on your own temperament. Item number 15, DEVO, the Amplify CWP Enhanced Dividend Income ETF. DEVO sits in a quiet middle ground between pure dividend ETFs and pure covered call ETFs. The strategy targets 2 to 3% yield from regular dividends plus another 2 to 4% from selective covered call writing on individual positions. Total yield works out to around 4 to 6% in most market environments. Expense ratio of 0.55%. Assets under management around $6.5 billion. About 30 to 35 concentrated holdings. Top names include Caterpillar, Microsoft, Apple, American Express, and JP Morgan. Sector mix is balanced across industrials, financials, and technology. The thing that makes DEVO different from JEPI and GPQ is the selective approach to call writing. Instead of writing options against the entire portfolio, the managers only write calls against specific positions when implied volatility makes it worthwhile. The result is a fund that captures more of the upside in big rally years compared to JEPI and JEPC, while still throwing off meaningful monthly income. For an investor who wants income plus growth participation rather than pure income, Devo is the most underrated middle ground in this entire chapter. We are 3 away from the most important one. The final pick on this list has done something only 1 or 2 other funds in this entire video have managed since the 1980s. It has historically beaten SCHD over the last decade by more than 1 full point per year, with a lower yield and a higher fee, and almost nobody talks about it. Before we get there, 2 more. Number 16 is the youngest covered call ETF on the list, and somehow already at $9 billion in assets. Number 17 is the international ballast that bails you out when the US market stalls. Stay with me. Item number 16. SPYI. The NEOS S&P 500 High Income ETF. SPYI is the youngest fund in the specialty cluster, launched in August of 2022, and it has already grown to over $9 billion in assets, making it one of the fastest-growing high-income ETFs in US history. Yield around 11.9% on a trailing basis. Expense ratio is the highest on this list, 0.68%. Over 500 holdings because the underlying portfolio simply tracks the S&P 500. The strategy starts with the full S&P 500 and then writes index options using SPX contracts, which get more favorable tax treatment than the equity-linked notes that JEPI uses. Top holdings are the S&P 500 megacaps, NVIDIA, Apple, Microsoft, Amazon, and Alphabet. Distributions are paid monthly. The reason SPYI deserves attention despite the higher fee is the tax treatment. The Section 1256 options that SPYI uses can be more tax-efficient in a taxable account than JEPI's equity-linked note structure. For a retiree holding income ETFs in a taxable brokerage account, that tax efficiency can be worth the extra fee. For an investor holding everything in a Roth IRA, where taxes are not an issue anyway, the higher fee just eats into returns. So the math depends on your account type. The general rule I use is that SPYI belongs in a taxable account, JEPI belongs in a Roth IRA, and Devo works reasonably in either one. Item number 17. VYMI. The Vanguard International High Dividend Yield ETF. VYMI is the international companion to VYM. Same Vanguard high dividend methodology, but applied to over 1,500 international stocks across Europe, developed Asia, and emerging markets. Yield around 3.5% on a trailing basis. Expense ratio of 0.22%, low for an international ETF. Assets under management around $19 billion. Roughly 1,600 holdings, the broadest exposure of any ETF on this list. Top names include Novartis, HSBC, and Roche, with no single position making up more than about 1.5% of the fund. Sector exposure is heavy in financials, healthcare, industrials, and consumer staples. The reason VYMI sits at item 17 near the climax is what it does when the rest of your portfolio struggles. During the strong dollar period around 2022, VYMI saw double-digit drawdowns as currency moves and slower overseas growth weighed on returns. American dividend ETFs looked safer that year. But when the dollar started to soften and value sectors abroad rallied into 2024 and 2025, VYMI delivered strong rebound performance and recovered most of that drawdown. The lesson is simple. International dividend exposure hurts more in some years and helps a lot in others. When the US market stalls, that ballast is exactly what bails you out. Compare VYMI directly against VYM, item number 2 on this list. Same Vanguard high dividend methodology, but VYM is your American paycheck with 6 basis point fees and US-only exposure. VYMI is its globe-trotting cousin with 22 basis point fees and exposure to 1,500 companies outside the US that almost no American investor would buy individually. In any decade where the US stops dominating global returns, VYMI is the part of the portfolio that catches up. The other underrated piece of VYMI is what it does to your sector mix. American dividend ETFs are heavily concentrated in financials, technology, and energy, which means a downturn in any of those 3 sectors hits the entire portfolio. VYMI's largest sectors are international financials, European healthcare, and global consumer staples, with completely different underlying companies than what you own through SCHD or VYM. That diversification is exactly the kind of thing most American retirees should own at least a little of, even if it does not feel exciting in any given quarter. Item number 18. DGRW, the Wisdom Tree, U.S. Quality Dividend Growth ETF. The pick if you only own one. The pick I have been teasing since the very first sentence of this video. The pick that has historically beaten SCHD over both 5 and 10 years, despite a lower starting yield and a higher fee. Let me show you the math, then I will tell you why it matters. Yield around 1.7% on a trailing basis, distribution yield closer to 2.5%. Expense ratio of 0.28%, more than 4 times what SCHD charges. Assets under management around $16.5 billion, roughly 200 holdings. Top names include NVIDIA at almost 8%, Apple at over 5.5%, Microsoft at almost 5%, plus a long tail of profitable dividend growers across consumer discretionary, healthcare, and industrials. The launch date was May of 2013, so we have over a decade of live performance to look at. Now compare DGRW directly against SCHD. Over the last 5 years, DGRW has historically returned around 11.33% annualized total return, while SCHD has returned around 8%. Over the last 10 years, DGRW has historically returned around 13.5% per year, while SCHD has returned around 12.25%. That gap looks small in any single year, but compounded over a decade, it is significant. Picture Harry, 10 years ago, choosing between SCHD and DGRW for his $100,000 dividend portfolio. He puts the entire amount into DGRW, reinvests every dividend, and walks away. Based on historical performance, that decision could have quietly turned into roughly $360,000 today. The same $100,000 in SCHD over the same period would have grown to approximately $320,000, a $40,000 gap. Both portfolios were simple. Both required no trading. The only difference was the underlying methodology. DGRW screens for quality, profitability, and dividend growth. SCHD screens primarily for current yield with quality filters. Over a full decade, the quality and growth tilt has historically delivered more total return. And here is the part that surprises most investors. Even though DGRW yields only around 1.7% today, after that 10 years of compounding, the dividend income on Harry's original $100,000 works out to about $6,000 per year. That is a 6% yield on his original investment. He gave up the comfort of a higher starting yield in exchange for a portfolio that grew faster underneath the dividend stream. There is one more thing about DGRW that almost nobody mentions. It pays monthly. While SCHD mails a check 4 times a year, DGRW mails one every single month. For a retiree building a paycheck replacement strategy, that monthly cadence on top of the higher long-term total return is genuinely meaningful. So why is DGRW the pick if you only own one? Because it solves the actual problem most dividend investors are trying to solve. They want their money to compound faster than inflation while still throwing off a growing income stream. SCHD does that well. VIG does that well. NOBL does that well. But over the last decade, on the data we actually have, DGRW has done it best, with a portfolio of profitable dividend growers, broad sector exposure, monthly distributions, and a track record that includes the 2020 crash, the 2022 drawdown, and the 2025 and 2026 dividend renaissance. Now, I want to be honest about the trade-offs, because no ETF is perfect, and this one is not either. DGRW carries a higher technology weight than SCHD does, with NVIDIA, Apple, and Microsoft together making up close to 20% of the fund. In a year where mega-cap technology stocks lead the market, that is exactly what you want. In a year where they lead the market down, DGRW will hurt more than SCHD does. The lower yield also means the income stream takes years longer to build to the levels SCHD provides on day one. If you need income now, DGRW is not the answer. If you need a portfolio that compounds faster while paying you a growing check that you do not need to spend yet, DGRW becomes very hard to beat. That is why it sits at item 18. Here is the pattern across all 18 of these ETFs. None of them are exotic. None of them yield 20%. None of them have viral YouTube channels built around them. They all do one job extremely well, with a transparent rule set you can actually understand. The foundational 6 are the obvious anchors, the funds that almost any dividend portfolio could reasonably be built around. The hidden 6 show that the same kind of disciplined investing can be applied in more interesting ways than just buying SCHD and VYM. And the specialty toolbox covers everything from monthly income on the US large caps to international diversification to quality growth. Now let me leave you with the simplest possible takeaway. If you took $100,000 and split it 5 ways across just SCHD, DGRO, VIG, NOBL, and DGRW, you would have a portfolio that owns hundreds of dividend-paying companies, has expenses well under 20 basis points blended, captures both current yield and dividend growth, and includes the climactic pick we just covered. Based on historical performance, that simple 5 ETF blend would have grown into something close to $170,000 over the last 10 years, while paying out a steadily growing monthly and quarterly stream of dividends along the way. That is what these funds are actually for. Not exciting, not headline-grabbing, just compounding while you live the rest of your life. The biggest thing I want you to take from this video is that dividend investing does not have to be exciting to work. The data from the last decade shows that steady, rules-based dividend ETFs have quietly built 6- and 7-figure portfolios for people who did nothing other than hold them through every drawdown and every market cycle. So, one small reminder before we wrap. Everything I have shared today is for educational purposes only. None of it is personal financial advice. Past performance does not guarantee future results, and no ETF is risk-free. Always do your own research,